Hey everyone, and welcome back to my channel where we discuss everything related to investing. The stock price of Tesla plummeted by 10% the day after the financial report was released, dropping to the critical support zone of $160 to $165. So, is Tesla's long-term fundamentals in trouble? Is this drop an opportunity to buy or a trap? Did their financial report provide any good signals? To answer these questions, today we will analyze Tesla's financial report and fundamentals. Firstly, when Tesla's financial report came out, the stock price actually didn't drop much. But after the conference call, the stock price immediately plummeted. Obviously, the market has been waiting for Musk to give an explanation that satisfies the market during the conference call, or say some exciting words. But obviously, the answers given by the management during the whole conference call did not satisfy the market. Therefore, the stock price began to collapse after the conference call. However, before we talk about the conference call, let's start with Tesla's Q1 basic financial data. Their Q1 revenue was $23.33 billion, a year-on-year increase of 24.52%, but a quarter-on-quarter decrease of 4.06%. On the other hand, EPS was 85 cents, a year-on-year decrease of 21% and a quarter-on-quarter decrease of 28.5%. But this also just met analysts' expectations. So Tesla's decline in Q1 revenue and EPS isn't a huge deal because it's all in line with Wall Street's estimates. The market has already priced in the fall in earnings, therefore what concerns the market the most is the company's outlook for the future, particularly in terms of demand and profitability. Because in Q1 of this year, the total gross margin of all businesses was 19.3%, which was lower than the market's estimated 21%. Although Tesla did not directly disclose the Q1 gross margin of its cars, if we calculate it manually, we will find that the Q1 gross margin of its cars dropped to 21.1%. This was lower than 32.9% in the same period last year and 25.9% in Q4 last year, which was also lower than Wall Street's expectations. Also, when we look at their global car inventory indicators, we will find that this number has been increasing in the past 5 quarters, which means that the supply days in Q1 of this year were 5 times higher than the same period last year. This indicates that Tesla's inventory is still increasing, which means that although they are continuously lowering prices, their demand is still declining. In addition, there is another signal indicating a demand problem. Tesla announced a price reduction again before the financial report, despite the fact that the total gross margin in Q1 was below expectations and EPS barely met expectations. The CFO stated that this price reduction in April would further reduce the car gross margin in Q2. This means that the previously stated minimum target of a 20% car gross margin has been completely shattered. This directly tells the market that they were forced to lower prices due to insufficient demand, not because costs were reduced quickly in the short term. Because if Tesla's demand is not a problem, the management will not easily violate the minimum gross margin guidance promised in the last financial report. After all, violating the previous target will make the market lose confidence in the management's short-term guidance and make the market more uncertain about Tesla's price bottom line. It is unknown how far the profit margin will fall. Especially during the conference call, Musk also said that they could even lower prices to the point where they don't make any money, and that's okay because they will make big money in the future with FSD, insurance, and other software services. However, saying this at such a time is not necessarily comforting. Instead, it makes people even more uncertain about Tesla's bottom line for price reductions. Therefore, after the financial report was released, Tesla's EPS for 2023 was directly downgraded by analysts from the previous $3.90 to the current $3.44, a decrease of more than 10%. It can be seen that even with such a significant decrease in profits, it is difficult for the stock price not to plummet. In addition, there is another bad signal. The delivery volume data for Q1 was lower than expected, but their production capacity target for this year is still 1.8 to 2 million vehicles. Tesla's business model is direct sales, so there are no car dealerships to help them absorb inventory, which means they must sell as much as they produce. However, if the deliveries for this year maintain the same, there are only 1.69 million vehicles, so the delivery volume for each quarter of Q2, Q3, and Q4 must exceed that of Q1 in order to achieve a delivery volume of 1.8 to 2 million. But the macroeconomic situation will only get worse, and a global recession may even occur, which means that Tesla is likely to continue to reduce prices this year to increase delivery volume to the level of production. If cost reductions do not keep up with the pace of short-term vehicle price reductions, Tesla's gross profit margin will be further compressed this year. The EPS expectations for this year may continue to be downgraded in the future, and the stock price may still have room to fall in the short term. However, stock prices will reflect the future in advance, and stock prices will move ahead of performance. In summary, based on these various factors and the lack of exciting product news in the conference call, it is normal for the stock to drop by 10% after the financial report. Furthermore, they continue to expand production capacity even when the economy is not doing well, which also indicates Musk's confidence in their software services such as FSD. So he believes that there is no need to sacrifice sales growth to maintain profits during a macroeconomic downturn. However, in reality, this is also the attitude he must show, because whether Tesla can sustain its current high valuation in the long term depends largely on the progress, story, and potential take rate of FSD. Therefore, if they give up sales to maintain profits at this time, it will make the market feel that they do not have enough confidence in FSD, and the entire company's valuation may be affected. Although Musk said in this conference call, true FSD may be achieved this year, personally, I don't believe this statement because Musk did not provide more visual data and evidence to support this prediction. However, as long as FSD can occasionally show progress in reality, when the real bull market arrives, Tesla will be able to maintain its valuation as a technology company for at least the next 3 to 5 years, and possibly even before FSD is achieved, it will be the highest period of return for investing in Tesla. In summary, Tesla's stock price still has some room for short-term decline. The recent price cuts and the lowering of EPS expectations are likely not the last for this year. However, 2023 to 2024 may be the worst period in the cycle for Tesla, just like the semiconductor industry over the past year. Currently, Tesla is experiencing a period of industry downturn, so it is reasonable for the short-term stock price to be adjusted. But when the economy begins to recover, the demand for Tesla and the automotive industry will also follow. At that time, as the pace of price reductions stabilizes and costs continue to decline, their profit margins will gradually recover. The stock market looks forward, and the stock price will lead performance. Therefore, I think it is possible to gradually build positions when Tesla's stock price falls to a more reasonable range. Currently, 160 to 165 is a technical support level for Tesla. However, it is okay to wait for support at 130 to 140 or even lower valuation. If the support at 160 cannot hold, it is very likely that Tesla will fill the gap below. Therefore, 160, 140, and 115 will be the 3 key support areas. If you have other opinions, let's comment below. Please help to like and subscribe.